The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The pressure builds on stock as the global pain points pile up. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking off to closing bell here in the U.S. Not quite at session lows on the S&P 500, but getting closer, down about 1.4%. The small caps, once again, really taking the brunt of the selling pressure. The Russell 2000 down about 1.7%. A lot of that traces back to what we're seeing in the bond market. Yields rising across the curve, including when it comes to the 10-year Treasury yield, higher by about 4 basis points, not providing a haven to what we're seeing in the Middle East as both the U.S. and Iran strike defiant tones here. And that's sending Brent higher once again, higher by about 10% right now, settling at $100, above $100 per barrel for the first time since 2022, Romaine.
Yeah, let's talk about that defiant tone here on a third straight day of losses for the S&P on the 13th straight day of the war. Conflicting and competing boasts and brags from the Trump admin and Iran's new supreme leader. The concern for markets, less about the military strikes per se, and much more about the increasing economic question marks around a major energy supply route being on lockdown for the longest stretch in history. Goldman energy strategist Dan Striven actually talking about this earlier today, raising his oil price forecast because of the prolonged disruption, noting that the real pain point, that is going to center on the Strait of Hormuz remaining choked through the end of March. Now, that's not his base case, but still a scenario he's modeling that he says would push Brent crude prices above their 2008 peak of $147.50 a barrel. Those barrels just actually settled here on the day above 100. Now, the market is also having to contend with the spreading weakness in financial stocks. You have an index of alternative asset managers like KKR and Ares barreling towards an 8th straight week of losses, while the KBW Bank Index, that's down for a 6th straight day, led lower by Morgan Stanley as one of its private credit funds telling investors it's going to limit withdrawals. In fact, Morgan Stanley shares, right now, they're on the cusp, believe it or not, of a 20% drawdown, Katie, from its last record high in January.
Meanwhile, let's take a look at the chart behind me. A little bit of a surprise here, but you can see that we're taking a look at short end yields across the globe right now. In white, you have the U.S. 2-year yield, the effective Fed funds rate highlighted right now. And you can see that it's really pushed higher. There's a lot of doubt right now over how much the Fed is going to be able to deliver when it comes to rate cuts that had been priced coming into 2026. And the question entering the conversation, whether or not they might have to actually hike rates should we really see this energy shock be sustained here. And you can see that it's not simply a U.S. story, really working its way around the globe. You also have U.K. and German 2-year yields highlighted as well, Romaine. So again, a global story here as we watch what's going on with these energy markets.
And of course, when we talk about that shock, a redhead crossing the wire just a while ago with Brent crude futures settling above $100 for the first time since August of 2022. At the same time, U.S. 2-year yields up 10 basis points right now on the day to 376 and change. Binky Chadha joins us now. He's chief U.S. equity and global strategist at Deutsche Bank Securities, kicking us off to the close here on this Thursday afternoon. And Binky, there's been a lot of talk here about the duration of the war, more importantly, the duration of these sort of energy supply choke points, and when they actually start to have less of an impact just on markets, but I guess more of a material impact on the economy and maybe even corporate fundamentals.
Sure. The first and very simple point that I would make is I think it's important when you compare oil prices over time to like prior shocks like you were just talking about. I think you kind of need to adjust for inflation. And so, if we are basically, let's do it in terms of WTI, if we are just, approaching 100, basically, I think Russia, Ukraine, we got to 145 in today's prices. You go back to 2008, you're talking about numbers that are way, way higher at like 185. So, the magnitude of the price shock is so far much smaller, basically, than we've had in the past. There's, of course, the much greater risk here of shortage of actual physical commodity and rationing, sort of like 1973-74. It is 20% of, daily consumption, basically, or production goes through there. So that's just,
Well, also, but can you also just draw a distinction between actually what we saw with the Ukraine war invasion a few years ago? I mean, that was more of supply effectively being removed from the market to a certain extent. For what we know right now, the supply is there. It's just a matter of getting it out of the Persian Gulf into where it needs to go.
I mean, the concern was very similar, I would say, and so what matters is what the market thinks might happen and the tail risks, rather than what actually and eventually basically happened. But my recollection is there were a lot of concerns that because of the sanctions and the like, a big part would be missing. In the end, oil proved to be just as fungible as everybody thought, and it recovered basically. But in terms of the risk premium coming out of oil prices, it took many years, is the way that I would put it. To come up with the risk premium, you have to have some idea what is fair value. We have a very simple model of what tells us fair value. We think it works pretty well over the medium term. And I mean, we sort of never got to so oil is pretty volatile, so we look at a 30% band around fair value.
Right.
And we went 50 and 60% above that, and we sort of never got into even the 30% range for a couple of years. So I think it's not really about oil prices. I mean, it is, obviously, it depends on, where we end up. But right now,
Let's talk about timelines here, because I'm taking a look at your notes, and you highlight 3 weeks. That you take a look at history, it suggests that it takes about 3 weeks for the markets to kind of become desensitized to headlines. How much conviction, how much faith can you put behind that timeline playing out once again, 3 weeks, just given the speed of the developments here?
Yeah, for better or for worse, I've found myself on television at 8 a.m. on the day that Russia invaded Ukraine. I went through the historical script, and I would say, clearly I had 0 buyers, but it worked out exactly that way. The first part, everybody understands, and I would argue, we are at a place where you kind of do need things to get worse for them to get better, because only if things get worse would it put sufficient pressure on, both sides for things to get better. And the equity markets, down 4% from the highs, and oil prices are up, but it's not comparable really to the prior shocks. Right. How much faith to put in the 3 weeks? I mean, there is the historical script that basically, the equity market falls pretty hard, 7 to 8% basically over 3 weeks, and then recovers in 3 weeks.
But do you think there needs to be a policy response to this now? And the reason why I ask is there's headlines crossing the wire right now with the president on social media calling for rate cuts now, not waiting for another meeting, et cetera. And it raises the question that if everything you're talking about here and the historical precedents of things being able to snap back and the fungibility of oil, do you need a policy response at this point, 2 weeks into the war?
I mean, the war is a policy, so definitely we need a response. But whether the right response, I don't think so. And I think it's relatively well understood in a slightly different context when we were talking about Fed independence and the like. I mean, the experience of 1973-74 oil shocks is that if you start accommodating them, yes, short rates will go down, and maybe that provides relief to some people. But the 10-year yield starts going up. We are in a phase where, all rates are going up. We can talk about how and why and the like, but I think if you consider a hypothetical of just suddenly cutting short-term policy rates, you usually see the 10-year go even higher. It would be my concern.
It's amazing because that's what we've seen the 10-year do. I think we're more than 30 basis points higher at this point versus immediately prior to when we saw the initial action taken in Iran. And I want to talk about how that's filtering through into the equity market, because overall it seems like oil is in the driver's seat. But you think, for example, about the small caps that I highlighted. They have been absolutely crushed over the past 2 weeks or so. I mean, how much of that is purely a rate story at this point?
I would say some of it is definitely a rate story, but I would say that what's been going on across markets, what's been going on basically within equities is, and I hate to use technical jargon, but it's really degrossing. So what people are doing is cutting basically their longs or overweights and also their shorts and underweights. And I would say, and the same chart that I'm going to describe works whether we are talking about sectors and industry groups in the S&P, whether we're talking about regional equities, whether we're talking about asset classes. Mm-hmm. And that is that if you look at the performance basically over the prior 3 months before this shock and how performance has basically been recently, there's a very strong negative relationship with about half coming just simply from what I would describe as positioning. Mm-hmm. I would say some of what's happened in rates is exactly the same story, where the market basically got long, maybe for other reasons. AI is going to impact the labor market and the like. So you're seeing those shorts get covered at a time of uncertainty. It's not necessarily a fundamental directional view that is playing out. And I mean, so, we've all been concerned about software, talking about software. And when oil prices go up, software did well. I mean, that's the clearest indication that it's just a positioning unwind of shorts and software that were the highest they've been since the global financial crisis.
We're going to get another taste of that tonight, some more software earnings, and we should also point out the sell-offs that we've seen over the last few days, not necessarily broad-based and certainly nothing off the cliff. Binky, you have to leave it there. Binky Chadha, Chief U.S. Equity and Global Strategist over at Deutsche Bank Securities. And speaking of investor sentiment, believe it or not, there was an IPO today. And when we come back, we're going to take a closer look at the geopolitical impacts and how they may or may not be affecting sentiment out there. We're going to take that through the lens of the IPO pipeline with Paul Abrahimzadeh over at 1789 Capital.
And a big part of that IPO pipeline involves AI and the tech sector. We'll be talking cybersecurity and keeping our tech safe with Hiddenlayer CEO and co-founder Chris Sestito.
And from the tech space to the consumer space, a closer look at the demand for specialty food products. We're going to talk to the CEO of Califia Farms, which specializes, and you love this, Katie Greifeld, those plant-based milks. All that and more coming up in a bit, right here on The Close on Bloomberg.
Blue Owl trying to regain investor confidence, defending its recent sale of $1.4 billion worth of loans from 3 of its funds. The asset manager arguing that the transactions contained no backstops or hidden incentives. Now this, after Morgan Stanley announced yesterday that it is limiting redemptions from one of its private credit funds. Bloomberg News chief correspondent for private capital, David Scigliuzzo, joins us now with more context. Davide, let's talk a little bit about this, because it's not just Morgan Stanley, of course. We've seen this redemption question come up also most recently with what we're seeing with Cliffwater, for example, their $33 billion fund. And I guess when it comes to the redemptions that we're seeing, how much of this is psychological, just sort of a feedback loop, versus, the investors asking to redeem have a sense that, okay, the marks here, they're going down and maybe that's not being reflected?
I think it's a bit hard to tell as of right now. You've definitely seen some pretty high numbers, as you mentioned, Cliffwater, but before them, Blue Owl, with double-digit redemption requests. They took very different approaches as to whether to honor all of them or limit the redemptions at 5%. But what it suggests is that there is a decent amount of investors that in just one quarter were spooked enough to ask for their money back. Now, the big question going forward is going to be, what does the next quarter look like, and for how long this magnitude of redemptions will continue. It is a process that will play out over the next several weeks. Definitely a majority of managers for now seems to have decided that enforcing the cap is the best thing to do. Allowing more could be a short-term solution, but if you think you may be in this position for a few quarters, that might not be the best solution for the long term.
But it gets to this idea, though, too, as to whether this starts to compound, just the image or the idea that, once people start to see that there are caps on the redemptions, that just creates almost to a certain extent other people who then say, OK, maybe there's something I don't know that's going on there. I know Apollo, we had the story the other day about Apollo kind of toying with the idea of maybe providing more public mark-to-markets, whether it's on a monthly basis or even a daily basis. Is that maybe the solution? Have we heard from any other of these asset managers saying that maybe they're willing to just open up the books on a more routine basis to the public?
Yeah, I think that is generally the direction of travel for the industry. And in part, it is related to them wanting to cater more to retail investors. The quarterly redemptions are already an avenue for investors, individuals, to get their money back more frequently than any institution that's ever invested in private credit was ever able to do. So the move from quarterly to monthly to daily kind of goes in that path. Obviously, the challenge is going to be for some of these loans, particularly the illiquid ones, that it may not be that easy to assess a company's fundamentals on a daily basis or even on a monthly basis. And so you may refresh the same valuation a few times. And if you do that, then you can allow greater liquidity in the fund. But I think the bigger concern a lot of people have around marks and valuations in private credit has to do to the relationship between that valuation and the underlying fundamentals of the companies.
All right, Davide, always appreciate you taking time for us. Davide Scigliuzzo, our chief correspondent for Private Capital, joining us today over there in Italy. When we come back to the United States and take a closer look at some earnings coming up after the bell. The makeup retailer Ulta Beauty. We're going to dive a little bit deeper into what to expect right here on The Close on Bloomberg. Let's get right to our top calls, the big movers on the back of analyst recommendations. And we start off with General Mills. Wells Fargo downgrading the cereal and snack maker to underweight, cutting the price target to a street low $35. The analyst saying consumption trends remain sluggish, commodity inflation is being revived, and corporate marketing expenses are already running tight. Those shares down for a fourth day to their lowest since 2019. Next up, Nutrien. Jefferies upgrading the fertilizer maker to buy, lifting the price target to $96. The firm says that while North American producers like Nutrien aren't directly affected by Iran, the halt in production by Mideast competitors because of the Strait of Hormuz closure, that's pushing U.S. spot prices higher just as the spring planting season begins. Those shares up a third straight day to their highest since 2023. And finally, UiPath. Needham upgrading the automation software company to buy after their fourth quarter results. While some analysts raise concerns about the company's growth prospects, Needham sees confusion surrounding UiPath's recent acquisition of WorkFusion, and he advises investors to buy into that dip. Those shares, though, dipping by the most in about a month. Those are our top calls, and we now push ahead to another company set to report earnings, and that is Ulta. Our next guest reiterating her strong buy rating ahead of that, saying that while the bar is high, she says Ulta can continue to deliver above market comps. Olivia Tong joins us now, managing director over at Raymond James Equity Research. All right, let's start off first with what your expectations are on year-over-year growth and whether you expect that growth rate to continue.
Great. Thanks for having me. Appreciate it. Yes, Ulta's reporting after market close today, and we have high expectations. We think the market expectations are high as well, but that they can deliver. The consensus right now for top line is 4% comp. We think that expectations are for our investors are probably closer to 6%. We think that the company can deliver. And if that's the case, then that bodes really well for as we go into next year. They've got a lot of innovation planned. You've already seen them launch a couple of new brands, Rare Beauty being one of them that they launched on February 1st. And we expect that to be a nice traffic and ticket driver. And if you get that top line growth, then you should get some nice margin leverage off of that as well, which can drive those earnings upsides on top of that.
Well, speaking of the margins, I mean, is there any concern here about some of their costs, particularly associated with the online business, and whether some of the issues that were raised on the conference call 3 months ago might not have quite been completely resolved?
Sure. I think the margins should look better this year. Last year, fiscal 25, was a year of investment, technology improvements, website improvements, store improvements, what have you, and also improving their relationship with the brands as well. So they've made a lot of investments in that. You think about like the sponsorship of Beyonce's Cowboy Carter tour last year. You're starting to see more of that connectivity with brands and also connectivity with consumers and influencers as well. They've got this Ulta Beauty World event next month. I'll be attending that, and from what I hear, there were about 3,000 tickets, and there was demand for 3 million, which is pretty insane. But it just speaks to the connectivity that they have with both, top of funnel, the manufacturers, as well as the consumers and the influencers out there.
And Olivia, what sense do you have of what international demand looks like right now? I know that they've been expanding outside the U.S. I mean, how is that push going?
Yeah, great question. International is still very new. Last year, they acquired Space NK, which is a UK-based retailer, a little bit more higher end. UK is very similar to the US in terms of how the consumer thinks about the category. They've also made slight inroads internationally, Mexico, and then Middle East as well. We're talking about 1-2 doors here right now. So very much dipping their toes in the water in those markets right now. But we'll see from here, as we think about the opportunity set going forward. I think that right now, at the end of the day, the bread and butter is really the U.S. It's still going to be the vast majority of their top line earnings contribution.
Well, when it comes to the Middle East, what they're doing in the UAE in particular, you phrased it dipping their toes. And that's what I was wondering about, the context of, how important that region is to, some of their expansion plans here. And you think about, what's unfolding geopolitically, how much of an impediment will that be?
Yeah, I think right now it is still very small. We're talking, single digit number of doors, right, on a base of almost 2,000 doors. So not really meaningful right now. But, to my point earlier, dipping your toes in, right? So it is a typically younger consumer and one that is interested in beauty. So, putting most recent geopolitical developments aside, it is a consumer base that is interested in these categories. Now, of course, given what's going on, it's hard to think about the opportunity set in front of you right now. But that said, the vast majority of the business is still domestic.
All right, Olivia, great to get some time with you ahead of those results coming after the bell from Ulta. That is Olivia Tong. She is managing director at Raymond James Equity Research. Certainly a high bar. Go ahead.
When was the last time you were in Ulta?
I like CVS for makeup.
Yeah.
We get a lot of really nice stuff professionally here, so.
We do, yes. We're a little spoiled here. I do every now and then I go up to the Ulta on the Upper East Side. It's always packed.
Yeah.
It's always packed. Yeah, I'm usually one of the few men there. I'm probably the oldest person there by like a factor of 2 to 1. But it's always interesting to kind of see, not only just the interactivity of it. It's a little bit different than Sephora.
Yeah. Absolutely. It is interesting to compare and contrast their different tacks there. But coming up, we're going to go to space, talk about a blockbuster IPO pipeline with SpaceX potentially joining the public markets. This is The Close.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld, just 30 minutes away from what's looking like a pretty ugly day on Wall Street, Romaine.
Yeah, of the 3 days of losses we've had, this is by far the worst. I also noticed, too, it seemed like the last few sessions, there was always this oscillation between gains and losses, as I think some people were kind of trying to buy this dip. Today, you're just not seeing it. Also, I noticed the volume is a lot lighter, too.
Yeah.
So maybe some folks are just kind of moving to the sidelines, kind of waiting whatever the heck is going on in the Middle East. Hopefully that plays out.
Yeah, just capitulating. Yeah. And again, I've been stuck on this, the fact that, where is your hedge right now? What is your hedge? It's certainly not bonds. It hasn't been gold. A lot of big questions there. But what's really interesting is that even with all this volatility that we're seeing, the IPO pipeline starting to perk up despite those swings. Issues nearly doubling year over year, even as they come off a hot fourth quarter. You have SoftBank-backed PayPay saying yesterday that it's gearing up for a U.S. IPO at $16 a share. And Bill Ackman back on the scene this week, filing for Pershing Square's public debut. Joining us live to unpack what's ahead is 1789 Capital partner Paul Abrahimzadeh, whose firm has invested in another big name in this year's IPO conversation. We're talking about SpaceX. Paul, it's great to see you.
Thanks, Katie. Thanks, Romaine. Great to be back.
So let's start exactly there, because, I mean, capital markets have been open. When you think about IPOs, you also think about M&A, and I wonder, you know, if there's any sort of optimistic takeaway we can glean from that.
There's definitely reasons to be optimistic. We look at the strong GDP print back in Q3 at 4.5%. You know, look at some of the tailwinds in key sectors in the private market. So I think the reasons to be positive about the outlook for IPOs and the new issue asset class. There are also reasons to take some pause. You've seen a compression in multiples at the high end of the market. Software multiples now mid to high single digits on a one-year forward revenue basis, down about 30%. Based on AI disruption fears. That impacts a lot of the tech backlog, the high growth IPO backlog. But to put in perspective, the markets are incredibly deep. So I know there are a number of big IPOs that are on the horizon. The average IPO volume in the US is roughly $50 billion per year. At the peak in 2021, it was $150 billion. You've got 3 large potential IPOs this year that could represent a meaningful portion of that annual volume. But put it all in context, the market cap of the U.S. equities is $50 trillion. So there's incredible depth of the market. I think once you see the VIX come out of this 25 to 30 paradigm, which is double the normalized level, we should definitely see a very strong bid for new issues.
Yeah, watching the VIX has certainly also been quite an activity over the past couple of days here. But I am curious what you make of what's going on in private markets right now, because there's a lot of headlines out there, most of them about private credit and some of the redemption requests that you're seeing there. But what are you seeing when it comes to the private company side of things, and how might that potentially affect the pipeline going forward?
The credit markets always move first. They're an important indicator of what to expect on the horizon for equities. So we need to look at that and assess it in terms of risk. The reality is there are some segments of that private credit market that certainly have weakness, although it seems at the moment to be more driven by liquidity needs for the underlying investors as opposed to true systemic weakness across that entire ecosystem. You asked about the private markets. You know, I look at our portfolio at 1789. We have roughly 30 portfolio companies, heavily skewed towards AI, software, and defense tech. The reality is it's hard to get a read on valuations for IPOs looking at the current cohort of public tech companies because growth has been brought down so dramatically. There are less than 10 public software companies growing roughly 30%. And you look at the private market, our portfolio, for example, the median revenue growth is 100%. Most of that's at scale. So it's very hard to get a read through on valuations. And I think that's going to be the challenge for bankers bringing companies public over the course of this year is you just don't have really good public comps.
Well, that's what I'm curious about, too, when we talk about some of those companies, particularly some of the ones in your portfolio, and we'll get to SpaceX, which is obviously going to be a no-brainer for a lot of folks. But some of the other ones that you're involved in, there's a lot of questions about you know, whether they could be disrupted by AI, basically the disruptors becoming the disrupted, but also just this idea of how you articulate what their long-term value is, given that no one really seems to know what the longer-term impact of AI is going to be, good or bad.
Without a doubt. I mean, we're doing our absolute best as we analyze these companies to try and assess that multi-year risk, recognizing that while we think a third of our portfolio, so roughly 10 companies, could be public over the next 12 months, many of them will be multi-year holds. And so we have to avoid that disruption risk. We do that by trying to pick the best-in-class winners across each vertical, whether that's in the model layer, the apps layer, AI-enabled software, defense tech, et cetera. But I think by trying to pick the best of the best within those verticals with scaled businesses, you know, commercial grade revenue, and what we think are highly durable forecasts, you can hopefully avoid some of those pitfalls. Clearly, you're seeing that shake out in public software with that multiple compression that I referred to. And frankly, you're seeing some of the enterprise software companies that have promised agentic solutions but have not yet delivered getting punished the most as it relates to compression on their valuation.
Perplexity is one of your holdings, correct?
It is.
Yeah, and how does that stack up when you sort of think about, I guess, some of the things we've seen in publicly play out between OpenAI and Anthropic, obviously some of the issues with the Defense Department, and how does a Perplexity sort of fall into that debate, if at all?
It's a fantastic company. I think it's a very competitive segment. And the reality is each of the companies that are touching the model layer are ensuring that they've got a deep moat.
But Perplexity is kind of across all of those.
It's across all of them.
Yeah.
And so when you think about application layer, for example, you need to make sure that you aren't incumbent or relying on any single model. But the reality is they've shown really very strong user metrics and very strong user adoption. We've also looked at companies like Reflection AI that we co-led for the Series B. They've put together a fantastic team, and they're really leading the open weight segment to give a counterbalance to the closed weight models that have had these recent issues you've seen in Washington. So many of the governments, you know, whether it's sovereign or enterprise customers, need to control their data. They can't have a commingled cloud. They want to be able to build their own proprietary application layer. And so we think open weight models is really where you're going to see a lot of that focus shift.
I want to take a little bit of a wild card turn here and talk a little bit about special purpose vehicles, because, you know, you think about 1789, you invested in SpaceX, and there's a lot of people who would like to invest in SpaceX, especially as we get closer to a potential IPO date. Bailey Lipschultz has a great article on the Bloomberg terminal about how there's all these special purpose vehicles that purport to have SpaceX and other holdings as well, some of the other hot potential IPO candidates, and how there's a lot of question marks over whether or not, you know, some of these SPVs actually have the holdings, have the relationships with the companies that they say they do. And I'm just curious, you know, given that you are an investor in SpaceX, what you make of some of these different access points that are trying to be created to some of these very hot companies.
It's a great question. 2 points on that. Number one, the best-in-class companies in the late-stage private market run a very controlled cap table. So they're highly aware of distribution of stock and how that works. And so we find those that control their cap table end up having, as long as the company's performing well, very durable valuations because there's no supply of stock in the secondary market. That's point one. Point two, we invest only direct on cap table. So we're very fortunate to have that direct access with the founder relationships, relationships with the board members and the VCs in those companies. And by doing that, we ensure that our LPs have just one layer of fees and have one path to liquidity based on our view at the general partner. There are plenty of SPVs in the market that go back to back through multiple layers. And if you're the end investor, you've got very little control on that position. You can have multiple layers of fees. And it can end up being a very convoluted process to unwind those positions when companies ultimately go public. So I think a key part of Bailey's article is touching upon the fact that there can be overhang in some of these companies post-IPO, post-lockup, because you've got such a broadly distributed shareholder base. All right.
And any insight into what the timing of that IPO might be?
No specific comments, but I think the market will be open once you see volatility come down, greater stability in broader equities and fixed income. There will be a very strong bid for these must-own names. I think we talked about it before. So many of these mega cap companies in the IPO backlog are must-own. They're going to be part of the benchmark very soon after going public. But we think that the market, as soon as we get past this period of volatility, will be open for those biggest companies to access the market.
All right, Paul, really appreciate it. 1789 Capital Partner Paul Abrahimzadeh talking about the opening up here of the IPO market, or the continuing opening up, we should say. When we come back, we're going to talk about a company already public and having one of their best days since 2022. Shares of Bumble buzzing higher, and that's because, well, AI, well, it's finally come for your dating life. That's coming up next on our Stock of the Hour, right here on Bloomberg. Time now for our Stock of the Hour, taking a look at shares of Bumble, having one of their best days in years after reporting quarterly results and a rosy outlook. But the real focus here is on Whitney Wolfe Herd's return to the CEO chair, and she's brought along AI with it, a new digital assistant called Dates. Here to talk a little bit more about this is Norah, Mulinda, Bloomberg TV markets correspondent. Bumble's been through a lot over the years. Whitney Wolfe Herd's been through a lot over the years. The world of dating app has been through a lot over the years, but it appears that AI is maybe breathing some new life into it. So explain to exactly what Dates is, with the caveat that both Katie and I are off the market.
Okay.
So, yeah.
Well, it's an opt-in tool that Bumble describes as a way to move deeper than just the surface level. So essentially, a user would talk privately with this AI bot, and it would ask them questions and go back and forth to kind of determine what their values are, their interests, and doing all these things without talking to a potential partner, right? You're doing this with the AI chatbot. And essentially, it's supposed to be doing that with other people as well and sending both people a message showing that they align. So it's essentially acting as the intermediary, the person or bot in between that's talking to two separate people and then connecting them with the message.
So ask them what their interests are.
Right, but you're doing this all personally, not to be shared on your profile.
Smile,
right.
What numbers to dial.
So maybe some things that you wouldn't be comfortable sharing on your profile, you'd be able to chat about with the bot.
I was going to ask, and maybe you can't answer, what if you fall in love with the chat bot?
Oh,
because
wow.
that's happening a little bit more.
That is happening more. I don't know what they would do there. That's a question I'm sure they're getting often.
Recently featured in TLC's My Strange Addiction, I believe. But anyway, it's amazing to see the pop in the stock. I mean, you take a look at shares right now, higher by, I believe, more than 30% or so. I mean, what is the sell side saying? Like, is anyone saying maybe we're getting a little bit ahead of our skis here?
So if you look at the A&R page on the Bloomberg terminal, we say that the stock has one buy, one sell. Majority of the street, 15 analysts saying to hold. So we did see JP Morgan. They did upgrade the stock to hold from sell just today. Off of this news, they're essentially saying that they think that it worked through its shrink to growth phase quicker than anticipated. But I mean, the stock is still down about 94% since it IPO'd back in 2021. It's been dealing with a lot of headwinds, including fatigue. A lot of people are tired of the dating apps. Maybe they want to get in person. They've also been having a harder time really targeting that Gen Z demo.
Well, that's
that
what I'm
apparently
curious about, because I was under the impression that this younger generation is kind of over a lot of these apps. And how does like making it even more tech forward help? I mean, because the anecdotes are is that they're going back to, bars and gyms and grocery stores, where you meet people the old-fashioned way.
Vibe now.
Right, or something, a healthy vibe?
I mean, a lot of Gen Zers, they're not drinking as much anymore.
Really?
So there really has been a health shift. Pilates,
Yeah.
matcha lattes.
Hot yoga.
Matcha lattes.
Hot yoga, to your
Some
point.
of that. Yeah,
awful.
Gen Z, they don't drink, they don't date. They're an interesting crew. Norah, Mulinda.
Well, they do have to procreate. They have to kind of keep the species going there.
I mean, do they?
I mean, if we want
We'll
them to
just
survive.
populate with
AI
robots.
forward.
Norah, Mulinda, she is our Bloomberg TV markets correspondent. Great job here on what's going on with these Bumble shares. But coming up next, it's the closing bell. We're going to take you there with Kristina Hooper. She is chief market strategist over at the Man Group. This is The Close on Bloomberg.
Just 10 minutes until we get to those closing bells. Stocks right now right around session lows. In fact, the sell-off that effectively started about a week and a half ago had not really been all that severe. We had some fits and starts, but a lot of dip buyers came back in to kind of keep things up. But for some reason today, not a whole lot of buying into the closing bells.
Yeah, it's pretty interesting to see here that this is the worst day that we've seen post-conflict. And looking like we're headed for our worst one-day performance on a closing basis in about a month here. The S&P 500 now firmly negative on the year, down over 2%. You can see that small caps really getting beaten up here, lower by about 2%. And the bond market, the sell-off lessening a little bit, but still 10-year yields higher by about 2 basis points. And then take a look at Brent right there.
Yeah, Brent crude at 101 a barrel, and WTI crude not far behind it. And it'll be interesting to see whether it catches up right now around 96. But I am still really focused on this move that we've seen higher in yields, particularly coming at a time when everyone pretty much assumed that rate cuts were in store at some point this year, and just that the economic environment would sort of been a little bit more benign when it comes to Treasury yields, but now obviously a lot of concerns right now, particularly on the long end.
Yeah, I believe the current pricing is for less than one full rate cut in 2026, which really speaks to how quickly sort of the calculus has shifted here. But to your point, I mean, this is something that's going on across the curve, this sell-off.
Yeah.
And I mean, it'll be interesting to see what a Kevin Warsh-led Fed does right here, because the expectation looking at these markets is that this is going to be an inflationary problem.
Yeah, and definitely a little bit of a tug of war now in markets between the short-term narrative and the long. Here to break it all down is Kristina Hooper, Chief Market Strategist at Man Group, counting us down to the closing bells. And Kristina, I do want to start with this idea between the short-term and the long-term, because I think a lot of traders were kind of dismissive when the war started. The idea that these energy shocks typically do tend to be short-lived, the impact on equities and even the economy tend to be just less impactful, if you will. But when we start to talk about a duration of a war, a duration of the Strait of Hormuz being shut down, you have to start talking about the potential longer term that there can be more meaningful economic consequences.
Absolutely.
Yeah.
I think for many traders and investors, their frame of reference was Liberation Day and the tariffs. That was the most recent crisis. And that was a very clean, shocking, and certainly had a lot of impact on markets. But it was very clean in that one could put on tariffs and as easily pull them off. That is not the case with this. And so I think there's some assumption that if tomorrow the U.S. were to decide to leave the Middle East, everything would go back to pre-February 27th. And I just don't think that's the case. And also, as you correctly pointed out, the longer we're in this, the less important it is that we've released strategic reserves, because this is an ongoing problem. This is a bottleneck, and it's not just impacting 20% of oil coming from that area. It's impacting 33% of helium coming from that region that needs to get through the strait, and on and on and on. So it is a very significant issue.
But at what point does this become not a commodity story? Because that's been the other reason why I think a lot of investors were willing to buy the dip. And, we've had some folks in this program that said, look, wake me when it starts to affect, the bottom line for Microsoft or for Alphabet or something like that. We know what the impact is in the energy space, in the commodities space. Is there any material worry now that this could be a much broader issue for, at least the publicly traded companies out there?
So we have to ask ourselves, who we are most worried about. And I think one of the key areas that I'm worried about is the U.S. consumer. And the rule of thumb has been that if you get oil at $120, $130 a barrel for any kind of sustained period of time, that is very likely to trigger a recession. And I think that would largely be driven by the costs, the increased costs that consumers face. And we're already in a K-shaped economy where the lower leg of the K is under very significant pressure. We've heard about affordability issues for many, many months before this. And this is only exacerbating a lot of the problems that we've already had. We're already in a semiconductor shortage. That only gets worse because of this, and on and on. So yes, it's going to take a while for it to hit the bottom line of Microsoft, but we're also not factoring in the other issues that we were worried about before this military strike in Iran, which was the AI apocalypse, sort of a whodunit. Which industries is it going to kill or do serious damage to, like software as a service, but far beyond that in terms of, working through who could be impacted. And then you've got private credit. So you have a lot of issues facing this economy and very few drivers. I mean, we were really seeing most of the growth coming from AI data center build out and high-end consumers and their spending. And if we see some kind of slowdown in those drivers, which could very well come from some of the factors that this economy is facing, it could be problematic.
Well, let's talk a little bit more about private credit, which of course is related to the AI software questions that have been percolating through the public markets as well. But I mean, the conversation we've been having is that it almost feels like a feedback loop when it comes to these redemption requests and maybe, just structural misunderstanding or mismatched expectations when it comes to liquidity. But I mean, what sense do you have? What do you make about what the fundamentals of some of these private credit portfolios look like right now? Because that's the big question. They're private by nature and certainly not as transparent as, some investors have gotten used to.
Well, that is absolutely the $64,000 question, and it is something of a guessing game. We can assume that there are some pressures, but it's unclear that this is anything incredibly dramatic. And so I would just say that it adds to fear, it adds to negative sentiment in markets, and ultimately, I think, just increases the pressure on the economy. In my opinion, it's just so many factors building up that at this point, it just seems more likely than ever that this economy goes into recession this year, which is not being priced in.
And before we let go, and we don't have much time left, I mean, it seems like it's oil that really is what everything else is keying off of right now. But you think about this big climb that we're seeing at the long end that Romain and I were talking about. I mean, how is that filtering through into the equity market, or is that just a detail relative to everything else right now?
Well, I think the rise in the yields on the long end has to do with not just expectations of higher prices, but also expectations around much worse fiscal situation for countries like the United States. And I think that's having a big impact. We know historically higher yields exert downward pressure on stocks, particularly longer duration stocks like technology, although that doesn't seem to be the case right now because that has become something of a safe haven asset. At least that's what investors have acted like and treated large cap tech stocks like in the last week and a half.
All right, Kristina, always a great conversation. Kristina Hooper, she's Chief Market Strategist over at Man Group, counting us down to those closing bells. Just about 2 minutes until we get there, with the S&P down more than 1%, the NASDAQ indices down about 2%, Dow Transport's down about 3% here, and yields pretty much across the curve, higher on the day. A full breakdown of all of today's market action and some big earnings after the bell. That conversation starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. On one of the worst sell-offs, actually, believe it or not, since the war started. I mean, we've had a lot of intraday sell-offs here, but of course, we've seen a lot of dip buyers come into the close. That's not necessarily happening today, Carol.
Yeah, it definitely feels like a much more negative tone, and I just keep thinking about what's going on in the Treasury markets. I get it, concerns about higher energy prices, and so we've seen Treasuries move up. I'm really curious about the inflation print tomorrow, and just to kind of get an idea of, again, where we are in terms of inflation, with or without war, even if some of these data points are older. You know, it just reminds us that the Fed maybe has to be on hold.
Yeah, Carol, you mentioned higher energy prices. I mean, look, WTI and Brent up more than 65% just this year. A lot of that happening in the last few weeks. Gas right now at $3.60 a gallon. That's the daily national average, according to AAA. You got heating oil at $5. At some point, like right now, that starts to hit consumers. If consumers are spending more money on that stuff, maybe they're spending less on other stuff.
I have to wonder, I mean, what is the haven to bring it back to the investment community? Because, you know, as Carol mentioned, you take a look at Treasury bonds not providing sort of that safety valve. You take a look at gold right now, down about 1.8% on the day. It really feels like there's nowhere to hide.
Absolutely, and we could talk about that big rally that we had seen in gold in the months leading up to this, and the idea now that that is pulled back as the inflation concerns set in. I do just want to put a finer point here on the sell-off that we are seeing today, because the biggest intraday drop that we had since the war started, that was back on March 6th. We had about a 1.7% decline, but again, the dip buyers come back in. So on a closing basis, this is going to be the worst day, not only since the war began, but really going back to mid-February. The S&P losing 100 points, or about 1.5%. The Dow down about 700 points, or 1.5%. The NASDAQ down about 400 points, or 1.8%. The Russell 2000 down 2, S&P mid-caps down 2, and Dow Transports, Carol Master, down about 3%.
Wow, that is a big move to the downside. I'm just going to go back, Romaine, if I may, to the S&P 500, almost 400 names lower for the trade, Katie, 111 to the upside. There were some gainers, and we've got one unchanged here at the close.
There are also some gainers when you take a look at the sector level as well. 3 sectors managing to finish in the green there, but you can see a lot of that circle is red. In terms of what did perform today, energy, no surprise, higher by about 1% as a sector. Also utilities and consumer staples, so pretty defensive read there. On the downside, industrials, consumer discretionary, healthcare, and tech. That is the big chunk of that pie. Tech down about 1.7%.
All right, guys, let's go to some of the individual gainers. We do have some earnings, and we'll bring them to you when they cross the Bloomberg terminal. In the meantime, I want to go to Palantir. That was definitely one of the outperformers here. It was up as much as 2.8% intraday, finishing the day with a gain of about 1.25%. The company out saying it may turn to other AI models amid the spat between Anthropic and the Pentagon. So their CEO on CNBC saying our products are integrated with Anthropic, and in the future will probably be integrated with other large language models. So that's kind of going on. As we know, the government has pushed back on Anthropic. I also want to point out that the company did unveil a software pack with NVIDIA, a defense partnerships too, at an AI conference with a bunch of players in the space, including something like GE Aerospace and a few others. So whether or not that was fundamentally why we're seeing the stock move up, I'm not quite sure, but it definitely was an outperformer. Investors swiping right on Bumble today. I know that's really bad, but I was going to go there. Stock was up as much as 49% intraday, finishing with a gain of about 34%. $3.81 is where the stock closed today, surging, biggest jump intraday since February of 2021. The online dating company, they did forecast EBITDA for the first quarter that beat the average analyst estimate. JP Morgan upgraded the stock to neutral, while analysts broadly noted that the focus now shifts to upcoming product overhaul planned for later in the year. So Morgan Stanley also coming out and say the company's financials starting to stabilize. Well, do you want to say something?
No.
Okay.
Speechless.
Just checking. Lightwave Logic, ticker is LWLG. That one up about 41% here. The now about $1 billion market cap company announced a development agreement with Tower Semiconductor to enable leading high-speed optical modulators. Stock is up more than 100% year to date. Yeah. I don't know if you know, but they develop proprietary electro-optic polymers and polymer photonic integrated circuit.
Romaine knew that.
Fascinating.
I did. I didn't.
It has to do with faster transmission for internet infrastructure, data centers, and AI applications.
Yeah, I do just want to add a couple honorable mentions, too, just given the big move that we saw in a lot of the chemical companies and the fertilizer companies. CF Industries closing at a record high today, having the best day of going back to 2020. And it was all those names, Mosaic and Nutrient and others. And this has real potential economic impacts because, of course, we are right at the start of the spring planting season here, at least in North America. So not having the fertilizer supplies within the next couple of weeks could actually have material impact.
I think I did CF yesterday, perhaps.
Yeah, today's a new day, Carol.
Okay. I'm going to jump in here and talk about some of the stocks that moved lower on the day today. I want to start with just the entire Mag 7. It's actually down more than 9% going back to those October highs. We had Tesla fall by more than 3%, Apple fall by 2%, Meta Platforms down today by 2.6%. Every single name in the Mag 7 was lower on the day today. Speaking of every name lower, let's go to airlines because airlines were all lower today. This is the S&P 1500 composite index of airlines down 4.3% today. You had Southwest down more than 7.7%, United Airlines down 4.6%, Delta down 2%, American down 4.5%. We know jet fuel prices are going up, could be going up. That's a big expense for these companies. Then you have the cost of plane tickets. That could jump as much as 9% as oil prices soar. This according to Willie Walsh, the Director General of the International Air Transport Association. Every name in that index lower on the day today. And then let's flip on over to Dollar General. Those shares under pressure today, having the worst day going back to August, down more than 6%. The company did give an underwhelming annual and long-term forecast. The outlook is conservative, according to Jen Bartashis, our analyst for Bloomberg Intelligence. Yesterday's close, though, through yesterday's close, it was up as much as 9.1%, and Romania was up 80% last year, so a little bit of selling today.
Let's talk software. Seeing some selling in shares of Adobe, the knee-jerk reaction to an earnings report that just now is crossing the wire. For the fiscal first quarter, the company reported adjusted EPS of $6.06 a share. That is a beat. The street was only looking for about $5.88 here. And on the revenue side, they also beat $6.4 billion in revenue. The street was looking for $6.2. But here's your forecast for the current quarter. The company says expect revenue in a range of $6.43 to $6.4 billion. The low end of that range is pretty much in line with the average of analyst estimates here. We're also going to talk about the performance obligations, the remaining performance obligations, effectively the backlog. The company's saying it stands right now at $22.22 billion. That's pretty much a smidge lower than what the street was looking for. So it looks like the numbers are relatively in line with estimates, but nothing really materially above those estimates to give investors a lot to chew on.
And you can see shares moving lower after hours. Let's quickly talk about Ulta here reporting results as well. Let's talk about the fourth quarter first. EPS missing estimates here, some of the figures. Fourth quarter EPS coming in at $8.01. The estimate had been for $8.11, but it's pretty mixed because then you take a look at their fourth quarter comp sales actually beating estimates, 5.8%. The estimate had been for 4.25%, and also their net sales coming in a bit heavier than the estimate. But when it comes to the fiscal year 2026 look ahead, they see net sales growth between 6% to 7%, also comp sales growth of 2.5% to 3.5%. You add it all together, you can see Ulta shares moving lower by about 6.6% or so right now, but the bar coming in was pretty high.
You know, I'm going back to Adobe. I'm seeing a headline, and I'm looking through the press release that's out right now. Adobe CEO announces a decision to transition. Shantanu Narayan, who served as CEO of Adobe for 18 years, has decided to transition from his position as CEO after a successor has been appointed. Narayan will remain as chair of the board. The board of directors has appointed Frank Calderoni, lead independent director of Adobe, as chair to the special committee to direct the process that will consider both internal and external candidates. So that's another headline from Adobe today.
All right, and the stock continuing to be under pressure in the aftermarket. It's down more than 20% so far here in 2026. The kind of main headline that we are so far highlighted is, again, what it has to say about the second quarter outlook for revenue, $6.43 billion to $6.48 billion, and the estimate on the street was $6.43 billion. So maybe investors were looking for something a little bit more in terms of a range. So certainly one we're going to keep a watch on. Adobe down just about 1.9% here in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romain continuing there on the close on Bloomberg TV. Tim and I returning to Bloomberg Business Week Daily right on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
Our coverage continues here of Adobe earnings results for the most recent quarter, relatively in line with estimates. Guidance relatively in line with estimates. But the headline now crossing the Bloomberg terminal that their CEO does plan to step down. And now a search for a new CEO is underway. Gil Luria, head of technology research over at D.A. Davidson, joins us now to talk a little bit about what we learned. I'm not sure what the bigger story is here, Gil. Is it the earnings themselves, or is it the departure that we're now learning about Shan Narayan?
Yeah, any abrupt transition from the CEO position is the bigger news. The quarter itself sounded like it was pretty in line. Guidance was in line. Adobe's actually a company that's had remarkably steady growth. Considering it's so undervalued and so underappreciated, Adobe has been able to keep around low double-digit growth for the last 3 or 4 years, in the face of competition, in the face of AI fears. So the quarter itself seems fine. The guidance seems fine. An abrupt CEO transition is always something that takes investors back, and investors will have to now be in limbo until the replacement is identified, designated, and they can evaluate that replacement. Yeah. That's always a position of discomfort for investors.
But that doesn't adding to that discomfort, Gil, is there were so many questions here about Adobe's future in the face of all this AI disruption, whether it was real or not. And the idea that you would want to make sure that there was some continuity in leadership, or at least some sort of certainty about leadership, and to have an announcement come out of the blue like this, as far as I can tell, there didn't really seem there was any speculation that he was even going anywhere. It really raises a lot of questions here about how they navigate just over the next few months, if not the next couple of years.
That's right. So that is going to be the concern. Now, I'll present the flip side of that, which is Mr. Narayan has done a good job getting Adobe to this place, which is a large software company that's had steady growth at very high margins, among best-in-class margins. Maybe the next CEO needs to be the one that brings Adobe into the AI age and changes the business in the way required to adapt to the AI age. So that's assuming they can find that CEO that can deliver that message of transitioning to this new era, they can make this into a positive. But again, there's a pause between now and when that person is identified, which is the one investors are going to have to now grapple with.
Well, Gil, just to push back a little bit, how much of a surprise is this really? Because you take a look at Adobe's stock performance since the beginning of 2024, it's been moving down in pretty much a straight line, lower by nearly 55% on a total return basis through today's close. So I hear what you're saying, that, the fundamentals of the business still look strong, look steady, but clearly there's been difficulty in communicating that to the shareholder base. So again, with that context, is this really that out of the blue?
No, that's exactly right. At the end of the day, the buck stops with the CEO. And if the stock underperforms for extended period of time, then the CEO is the one being held accountable for it. And likely that's what happened here. I'm just trying to be fair and balanced to Mr. Narayan and say, it's not the performance of the company that's lacked, it's the performance of the stock. And that has, especially these days, a lot to do with narrative, with these assertions that others are making that software's all a zero and that the terminal value in 5 years is a zero. I think that scared a lot of investors, especially since Adobe has become the poster child for that assertion. So I'll give him credit for the fundamental performance, but then he also needs to take accountability for the share performance.
Mm-hmm. And with that in mind, Gil, you touched on this a little bit, but what do you think that the market wants to see out of the next CEO? How can the new leadership, whenever it's named, sort of communicate that message more effectively? And I also think it's interesting that Adobe shares down about 6% after hours, so not necessarily cheering this transition news.
Yeah, that's right. So the opening of the aftermarket activity was barely flat or maybe slightly down. It's the CEO news that's causing investors to worry. It's a tough job for the next CEO. So who that person is, whether they're credible in the AI realm, will be important. In terms of the message, it just has to be a change of direction. Adobe has really said, look, we're fine on AI, we're agnostic, we're going to be have responsible AI for responsible image and video generation. That message clearly has not resonated with investors. So that message has to be different. How is Adobe going to be aggressive? How is it going to go on offense and have its own perspective and its own models maybe, or participate through M&A in acquiring whatever properties it would require investors to believe that Adobe has a place in the AI future? That is a tough task on whoever that next CEO is.
All right, Gil, always appreciate it. Gil Luria, head of technology research over at D.A. Davidson. Those shares remain under pressure. We're going to get back to that story in a second, but we do want to stay in the software space, stay in the AI space, and talk about Zendesk. The customer service software company has been on a buying binge. Heading into this month, it had made 6 acquisitions in the AI space over the last couple of years, and as of yesterday, it is now 7, agreeing to acquire the company Forethought. It's an agentic AI customer service platform. And pleased to say that the heads of both of those companies joins us right now. Tom Eggemeier is the CEO over at Zendesk, and Deon Nicholas is the co-founder and executive chairman of Forethought. Great to see both of you gentlemen. And Deon, I'll start with you. First of all, congratulations. You spent a lot of time building up this company. Why sell now?
Thank you so much, Romain. Excited to be here. At the end of the day, agentic AI is really going to be the single biggest impact, the single biggest technology that we're all going to see. And we set out on this vision and on this mission 7 years ago to transform the customer experience with AI. We've known the Zendesk team very well. I've gotten to know Tom very well over the many years. And we could not think of a better partner and a better time to be accelerating this mission in order to achieve global scale with Forethought and now with Zendesk.
So, Tom, talk a little bit about how this gets integrated, not only into Zendesk overall, but how it sort of pairs, if at all, with some of the other recent acquisitions that you've made in this space.
Yeah, we've been deliberate the last couple of years. We knew AI is going to disrupt the market fundamentally. And so for 3 years, we've been building for this moment. We've got a goal, stated goal that we're going to achieve of $1 billion of AI ARR in 2028. We ended last year at 200 million. We're going to end this year at 400 million or more. And what this does for us is just a great team that's Bay Area based, San Francisco Bay Area based, with the best innovators in the world, a great product that is going to help accelerate our current roadmap. And it's all about serving our customers in that AI journey.
And Deon, I'm curious, so, when you think about sort of the interaction with actual humans, the goal here is to cut down on the number of times that you have to have those human interactions. But in terms of how, your end user is actually using this, how do you make it so that the AI agent is actually something that they would want to interact with? Because you think about, the experience of people going to a travel site or something similar. You see the little chat box pop up. A lot of people just click right out. So how do you get around that very human urge to do that?
Absolutely. And we've been delivering in this AI space since, in many ways, before it became a buzzword. We now serve billions of interactions every single month for companies like Airtable, Upwork, UPS, many, many more, and beyond. And what we've seen over the years is that many businesses made the mistake of thinking about AI as purely an efficiency or an automation tool. We think about AI as a tool to actually help you deliver on the experience to your customers, right? Leveraging state-of-the-art agentic AI, and that means AI that doesn't just answer rote questions, but AI that can resolve customer problems, go and figure out things like where is my order, where is the refund, or anything like that, and then ultimately host a very human, empathetic conversation with the end user. And because of that, customers are getting their questions answered faster, and they're actually seeing an even better experience in many cases than when interacting with a human agent. So this idea of, hey, I just want to press 0 and talk to a human is actually a thing of the past when it comes to agentic AI.
And that's one of the things we loved about Deon, Sammy, and the whole Forethought team. A lot of companies are just trying to get deflections, get the customer not talking to them. Forethought is exactly what Zendesk is trying to do. We're really symbiotic here. We're trying to resolve the customer's issues, and that's a fundamentally difference from us with our other competitors.
And Tom, as Romain mentioned, I mean, this acquisition, just one of several deals that you've done lately. So you think about sort of your product portfolio at this point. Does it look complete? Or are you looking potentially for more deals here?
We're really excited about our product portfolio right now. We've got a great AI agent. We've got many AI agents. We have AI Copilot, AI Admin Copilot. We have generative search on our knowledge base. We have quality assurance, all new AI the last three years focused. We're going to keep doing M&A. We think this is a rapidly moving market. We're really excited about our organic capability for development. A lot of our innovations have been organic, but we're not going to shut down AI. It's a really dynamic marketplace, and we're going to continue to be the leader.
Is this all, I mean, not to speculate too much, but are there plans to go public again, to bring Zendesk back to the public markets, Tom?
We're really happy being private right now, Romain. And the reason we are is there's just so much transition, and we're able to do things that are focused on our customers, like we will move to resolution pricing. So we only get paid right now if we actually resolve our customers' problems. And those types of things are much easier to do as a private company. At some point, we're looking to go public. We want to pass that $1 billion of AI ARR first.
Right.
So look for it in the future, but we're really excited. If we're known, what we're doing right now is well known, that we're the #1 service AI company, where all of the options are going to be on the table.
But you're still scaling, right? I mean, you still say you want to scale up. You have the capital to do that?
Absolutely have the capital to do that. Our investors have been incredibly supportive. They see the opportunity. We've spent over $500 million the last 3 years on acquisitions, and we're going to keep making acquisitions. We're going to keep investing in research and development. We've upped that level to over $400 million a year now. That's largely focused on AI. So our investors are supportive. We have the capital. We have the cash flow to keep investing. It's all about resolving our customers' problems.
All right. Tom, really appreciate you taking time and wish you the best of luck here as you continue to build out Zendesk. And Deon, it's been a great ride, and I know we'll talk again. Congratulations on the sale, and looking forward to see what you do next. Tom Eggemeier there, the CEO of Zendesk. Deon Nicholas, the co-founder and executive chairman over at Forethought. When we come back, we're going to talk cybersecurity in the tech and the AI space. We're going to do that with the CEO and co-founder of Hiddenlayer. That conversation after the break, right here on Bloomberg. Let's take another closer look at shares of Adobe. Still under pressure here in the after-hours session, largely not so much because of the numbers in their earnings report, but largely, of course, because of the transition now, the unexpected transition to a new CEO. Of course, when we talk about software and we talk about AI, cybersecurity is a big topic in that space, particularly coming against the backdrop of the war in Iran. And on that note, our next guest has new insights on those risks from the latest AI threat report. It's out by a company called Hiddenlayer, and joining us right now is the CEO and co-founder of Hiddenlayer, Chris Sestito. Tito, great to see you. Let's talk about this report. And I'm going to start off first talking about it against the backdrop of the war in Iran, because there has been a lot of concerns here about not just the military strikes, but the potential for a nation state like Iran to use their cyber know-how, if you will, to retaliate against the U.S. and any other enemies that it deems enemies. I am curious as to whether you've seen or witnessed any sort of uptick in potential malicious activity out there.
We have, and I think that that's a very common pattern. Anytime you see any, new event like this, like a war, any sort of geopolitical aggressive behavior, this always sparks additional cybersecurity activity. We see it, our customers see it. It's something that happens across the board. And the new flavor of these types of attacks is going after agentic systems directly, which Iran and just about every threat actor is starting to target.
And this kind of brings us to, and we've talked about this before here, with the sort of the burgeoning AI industry, if you will. The models that a lot of these large language models use, which create a whole new different set of vulnerabilities, a much more complex set of vulnerabilities. So with the report that you have, obviously data and information collected before the war broke out, what was kind of your main takeaway in terms of how well protected or maybe not well protected these models are?
Yeah, I think there's two main stories alongside the data that we've been able to collect and the research we've been able to do. And number one is, the patterns of attack, the accomplishments and what the results that these threat actors are going for are exactly the same. They want to gain access to your data, to data they shouldn't have access to. They want to exfiltrate that data and use it for monetary gain or to cause harm to the organization. But what's new about it is the agentic and Gen AI attack landscape is effectively a complete new area for these organizations to attack that's almost completely undefended. There's, as mentioned in this threat report, we surveyed over 250 IT leaders at enterprise organizations. Over a third of them claimed they wouldn't even know if their agentic AI systems had been attacked. Now we're seeing over 1 in every 8 threat actors that are, 1 in every 8 attacks that are going against enterprise organizations are attacking agentic systems specifically. And it's because the security controls to defend these systems have not been widely adopted yet.
Well, I mean, do you have any sense of who is behind these attacks? Whether or not, it's groups of individuals, whether, it's governments, staging these attacks? I mean, what sense do you have of the actual humans who are directing these agents?
Yeah, the answer is it's really the same threat actors who are conducting the prior attacks. It is state actors. It is some independent organizations and some independent people. A lot of the agentic technology isn't just being used to deploy these agents out there today, but you can actually use them to conduct attacks themselves. You can hunt out things like who should be my next victim and where should we deploy and how will we be the most likely to conduct a successful attack. And so threat actors are actually starting to leverage this technologies, and it's creating a scenario where there's a very low bar of entry in order to conduct these types of attacks. You don't need to be an adversarial AI expert. You don't need to be, someone who has been conducting threat attacks for decades or anything like that. You just need to download the readily available tools off the dark web and start conducting them. So we've definitely seen attacks from threat actors, from state actors, from nation states, as well as independent groups that we would have in the past considered not quite so sophisticated and advanced, but they don't really need that anymore.
Mm-hmm. And Chris, just quickly here, I mean, you mentioned in terms of who's being attacked that you were talking to IT leaders at, sort of enterprise organizations. But I mean, are there any trends developing with the targets, whether or not we're talking about individuals or we're talking about the enterprise level or we're talking about governments coming under fire as well?
Really, anyone deploying agentic systems, as these threat actors don't need to do any additional work, they can crawl the surface areas of these organizations and identify potential victims in an automated way. So you don't need to be, you're not too small to be attacked in this case. In fact, many small organizations are also ripe with things like credit card information and PII and other data that represents a big value opportunity to these threat actors. And so with the rise in the automation of these attacks and leveraging the agentic systems themselves in order to be using Gen AI and other advancements to be able to conduct these attacks.
Right.
It's really every organization that's got a connection to the internet.
All right, Chris, really appreciate the time. That is Chris Sestito. He is Hiddenlayer CEO and co-founder. This is The Close on Bloomberg. Well, oil markets seeing little relief as the Iran war continues on. Bloomberg was the first to report that the Trump administration plans to waive a century-old maritime law in attempts to tame the surge in oil and gas prices. Here to discuss the broader conflict is retired U.S. Army Brigadier General Mark Kimmitt, also the former Assistant Secretary of State for Political Military Affairs, and also the Deputy Assistant Secretary of Defense for Middle East Affairs. So clearly an expert in this space. Fantastic to have you with us. And I mean, it's interesting. What everyone wants to know is what the potential time frame is here. And I mean, reading what the president has been saying and speaking and posting, it seems like the U.S. would like a quick end to this conflict. But perhaps the tone shifting a little bit today when it comes to what we're hearing from the U.S. and, of course, what we heard from Iran's new supreme leader here.
Well, that's really a question that needs to be directed at the Iranians. I think this president is willing to fight, hopefully is willing to fight until we've achieved some measure of, quote, victory, unquote. But the Iranians have to agree to that. They're the ones that have to come to us and say, no more. We can't take this beating anymore. You're crippling our economy. You've wiped out a lot of our military infrastructure. So let's stop this war. So my point is, it's up to the Iranians. It's really not up to us.
Right. It's interesting. I mean, when we heard from President Trump saying that this war was very complete or nearly so, I'm not sure if the Iranians would have agreed with that. So, I mean, to your point, this is in their court. And I wonder at what point you think we could be getting there. When you think about, what we're seeing in terms of the fighting, in terms of the missiles and drones going back and forth on both sides. I mean, from your view, are we getting closer, or how long potentially could we be?
Well, first of all, it's important to understand that victory is not a military conclusion. They're running out of targets for sure. And I think it's important to recognize that our military has done an absolutely brilliant job. But that job that the military has done needs to translate into victory. In many ways, we're doing what we hated in Vietnam, which is body counts. Now we're doing missile launcher counts. And as we knew from Vietnam, that's not going to be enough. So in my mind, what we've got to do is send a very clear message to the Iranians that the fundamental issues that brought us to the negotiating table that weren't solved, so are now trying to be solved on the battlefield, need to be the predicate for coming back to the negotiating table. Wars end at the negotiating table or at the surrender table, and I don't think we'll get the Iranians to surrender.
Okay, well, I am curious about some of the other issues sort of attached to this war. The idea that the Strait of Hormuz is still effectively closed, more or less. And I am curious that, given the military operations, if at all, we would actually see some of that military power used, if not to escort vehicles through the strait, but at least to maybe provide some sort of cover to make sure that it is open and safe enough for ships to travel in and out of.
Well, I think the military is already planning for that. We've done that before in the 81 to 89 tanker war. We reflagged the Kuwaiti vessels. We had U.S. military escorts taking oil in and out. The problem, of course, at that time was the U.S. was considered neutral, not considered a belligerent. But there is a capability to bring what I would like to see an alliance effort of escorts and countermeasure ships to get us through safely. I don't think it can be done by the U.S. alone. It needs allies to help us.
Well, can you compare and contrast, though, what we saw during some of the Persian Gulf wars? Because there did appear to be, at least by sight, a much more visible presence of U.S. naval ships in that region, if not necessarily in the strait, but certainly around the Gulf to protect not just ships, but obviously to protect some of the other Arab states and others. And I am curious as to why we haven't seen a little bit more of that presence yet.
Well, first of all, there's a huge presence. We have aircraft carriers not only in the Persian Gulf, but in the Red Sea as well, in the Mediterranean as well. There are a huge number of destroyers, frigates. But candidly, the important thing to understand is that the targets are being attacked primarily by aircraft. And it's certainly the case that there are enough aircraft in that region to put our ships in a very vulnerable position. The risk is worth the reward. We do have a lot of ships that fire air defense missiles that are stopping, for the most part, drones and ballistic missiles, but it would seem that there's just enough to do, to do it.
Can I just ask you, is it harder now, I mean, given some of these more, I don't want to call them rudimentary, but some of these lower cost types drones and things that we've seen the Iranians use, is that harder to defend against than, say, some of the more traditional missiles that they were using back during the, that were not necessarily them, but Iraq and others were using back during the Persian Gulf Wars?
Well, I think the answer to that question is imitation is the highest form of flattery. We have reverse engineered the Shahed drone of the Iranians. We're using it in this war. It costs us $30,000 to produce. It costs the Iranians $50,000 of their precious money to use. So I think that the answer is drones have made a significant, or have had a significant effect on the battlefield. But I don't think that's going to be a long-term phenomena in warfare.
I do want to quickly bring Israel into this conversation. We don't have a lot of time left, but you think about what the U.S. has articulated, what they're trying to accomplish here. President Trump saying today on social media that preventing Iran from having nuclear weapons and threatening the Middle East was the goal. You think about what we heard from Netanyahu yesterday, talking about how they want to bring the Iranian people to cast off the yoke of tyranny. It seems much more about regime change on Israel's part. And I wonder what you make of what seems to be a wedge wedge that's growing between the two different end games for Israel and the U.S.?
Well, I'm not sure it's a wedge, but it certainly is a different in strategic objectives. Obviously, the U.S. wants to prevent Iran from having a nuclear weapon, and I think Israel is more than happy to subcontract to the Americans to do that. But I would say that the Israelis want to get rid of the only country in the world that has a supreme leader, sees the supreme leader and the rule by clerics as part of the problem inside of Iran, which is why they took out the first supreme leader and could very well be trying to take out the second supreme leader. Whether those are complementary or contradictory objectives, we'll find out soon enough.
All right. I always appreciate your time. Retired U.S. Army Brigadier General Mark Kimmitt there as we continue to keep an eye on what's going on in the Middle East. Katie?
Also keeping an eye on what's moving after hours. We did get earnings out of Adobe and Ulta at the top of the hour. You can see the reactions in markets punishing right now. Adobe announcing a CEO transition here, down about 7%. Ulta down even more, giving a cautious outlook for the full year. Shares down nearly 9%. This is The Close on Bloomberg.
Well, this week's Consumer Price Index report here in the U.S. actually showed higher costs for groceries, making the competition for what brands customers will spend their money on just that much tougher. And top of mind, well, is also about the pursuit of healthier lifestyles. It's a shift that has been a major catalyst for the rise of alternative milk products, almond milk, oat milk, a lot of other milks, and, well, things that aren't necessarily milks. Califia Farms is, of course, at the top of that thing, hoping to cash in on the growth with an array of plant-based beverages spanning from creamers to teas and beyond. Joining us right now, pleased to say, is the CEO of that company, Califia Farms, joining us right now. Dave, great to have you here on the program. You know, we joke a lot here on this program. We should point out, you know, world headquarters here at Bloomberg, stocked full of alternative milk products. It is all the rage. I am curious, though, as how you've managed to stand out, given that we've seen a lot of other players already come and go in this space, if you will.
Yeah, Romaine, thanks for having me, first of all. You know, I think Califia has really always been the one defining what I'm going to call the premium, and premium in our space really means both a combination of nutrition and I think we keep redefining that. So what's driving our growth today is our simple and organic lines. It's about meeting the consumer where they're heading, right? Transparency in ingredients, give me the fewest possible things, but boy, make it taste better than it even did before. And that's what we've cracked the code on. And that's really been the catalyst for our growth this year and really for the last few years.
I am curious, though, I mean, given your background in the food industry, how important has it been to sort of leverage relationships with the grocery stores, with the distributors, to make sure that your name is front and center?
Yeah, I've always operated in a principle that it's a three-legged stool, right? We have to be there for the consumer, we have to be a partner to the retailer, and we have to do what's right for our company. And so relationships are critical, right? The retailer is our access point to the consumer. It's how we show up. It's how people find us. And so we're constantly working with them to bring them innovation, to bring them things that make it exciting to go to the store. It may not sound it, maybe just for a guy like me who loves going to a grocery store, but we want to make that experience joyful. We want to make solutions available, and we want to create new opportunities for usage.
You love going to the grocery store?
I know. But
it's like you and my wife are like the only two people. Yeah.
I actually love going to the grocery store, too, but my husband does all the heavy-duty shopping. I'm just there for the ride. But, Dave, we've learned in the past, decade or so that you can make milk out of a lot of different things. I mean, Romaine mentioned a few of them when it comes to oat milk. You have almond milk, all sorts of milks out there. Have you noticed a trend in sort of which of your products in terms of alternative milks are the most popular?
Yeah, so if you look at it for literally the last 15, 20 years, almond milk is the king. So about half of all alternative beverages are consumed are almond milk. The next largest is oat, then you get to coconut and soy. So it's really less dynamic than you might read about. I mean, all the press was very much behind oat milk just a few years ago, but really we still see that. And what we generally see is different plant milks give you different experiences, which is why we carry a portfolio. Because some are maybe more rich and creamy, something like almond milk, very low in calorie, no sugar, very healthful product to add to maybe smoothies and cereals. So we carry a range because there's a range of needs and usage occasions out there.
It's interesting to hear that almond milk is still king, because I remember a couple of years ago, almonds are having a little bit of a PR nightmare when it comes to their environmental impact. You know, the allegations that they're very tough on the environment in terms of how much water they need. And I mean, it sounds, again, listening to what you're saying, that maybe it's moved past that a little bit.
Well, it always depends on what we compare it to, right? So if you compare almond milk to, let's say, traditional cow's milk, you're still using 1/3 the water, because you just think about the cycle. You got to grow things for the cow to eat things, for the cow to drink water, just to get milk. So it's vastly more efficient from a carbon emission standpoint, from a water use, and from a land use. Still, you know, it's like I said, it's 1/3 of what a cow's milk is. If you compare it to, let's say, our oat milk, yes, it uses a bit more water than oat milk, but all of these are vast improvements on environmental footprints compared to traditional dairy.
I am curious, though. I mean, when I look at your product line, I mean, there does seem to be, you do seem to have a very specific focus using almond, whether it's for the milk themselves or for the other products as a base. Obviously, I see coconut as well. Has there been discussion about branching out to other types of nuts? I know you say almond is king, but I mean, I've tried a few, like, you know, cashew milk, which was tasty, macadamia nuts, which I didn't really taste the difference. But, you know, I mean, you want a variety and maybe just be able to sample different things.
Yeah, I mean, we're kind of plant agnostic, we say here. We try to explore all kinds of the different benefits. We have a cashew milk, right? From that standpoint, we have worked with pistachio milk. So I think what's always the intersection of what is the benefit that that particular ingredient brings to consumers from both an experience and a nutrition standpoint. But we're always looking at different things, working with proteins like a pea protein, et cetera. So all those are finding their ways in our products, all with the goal of making them delicious and, candidly, a nutritious beverage for people.
So what's next? I mean, what is the next new milk? It sounds like, again, we've made milk out of just about everything, but maybe I'm being unimaginative.
Well, I don't know about that, but I think what we're really trying to do is always make our products more nutritious. So if you start to think about where things might go, you might start to see plant-based really expressing more opportunities across protein. Plants are a great source of fiber. If we think about one of the things that doesn't work well in the American diet is enough fiber. These are natural ways for us to be able to incorporate into our products. So our goal is always to make them more nutritious without compromising the irresistible taste.
All right, Dave, so enjoyed this conversation. Great to get some time with you. That is Dave Ritterbush. He is the CEO of Califia Farms.
I have an answer to your question.
Yeah, go on.
Legumes.
Legumes.
Yes, I actually just in fairness, I just put this into ChatGPT and see. But no, apparently chickpeas, lupin, which I've never heard of, and broad bean are apparently starting to get a lot of R&D attention. Also pecans and sunflower.
I believe it. You know, it's not all about protein, as Dave was saying. You need fiber as well. You're going to find it.
Look at that, ChatGPT. That is worth trillions of dollars of investment right there.
Product innovation. Man, we're going to work on that in the commercial break. But coming up, what investors need to watch over the next 24 hours.
I thought we were talking weddings.
This is Bloomberg. Well, here on The Close, we focus on markets of all kinds, the stock market, the housing market, and the wedding market. The Knot Worldwide is out with their 2026 Real Wedding Study, which shows that the over $100 billion U.S. wedding industry has proven to be resilient despite those macroeconomic headwinds. Joining us to discuss is Raina Moskowitz. She is the CEO of the Knot Worldwide. Raina, great to have you with us.
Thank you so much. It's great to be here.
So let's go to this figure in your study. That is that the average wedding cost held steady at $34,000 year over year. I guess, you know, it's interesting that it held steady. Maybe that's a good sign. But $34,000, I mean, you think about what we talk about on The Close all day, that stubborn inflation, the tapped out consumer. When it comes to weddings, though, that's in a category of its own.
It truly is. So the wedding category, the wedding industry is incredibly resilient. And of course, you sit here all day talking about everything going on. And despite what's happening, despite macroeconomic pressures, couples continue to prioritize investing in their big day. And I think that's for a few reasons. You know, couples and consumers, there's this underlying craving for connection and celebration. And so this is the biggest day, most likely, in your life. And it's also likely the most expensive day. But couples continue to prioritize it despite pressure. So, you know, it's been incredible to see that the average budget, which is a national average, has held strong.
Yeah.
Guest counts have held strong. In fact, the average guest count for a wedding has increased from 116 to 117.
Wow.
Driven by Gen Z weddings. So, you know, just weddings are resilient, but also we're seeing a trend that Gen Z is excited to get married as well, and they've sort of entered that prime time, though still slightly on the younger side, and they are prioritizing weddings as well.
It's funny, there's inflation everywhere, even when it comes to wedding lists.
How many people were at your wedding?
It's 200 something.
Wow.
Okay.
Yeah. I got married young. I was like, let's invite everyone I knew from college.
Yeah.
Anyway, I'm curious, you know, of that $34,000, what are the biggest tickets there? Is it venue? Is it food? I mean, what are they actually spending that on?
Yeah, the venue is a big ticket. And that's typically the first thing that a couple will lock in and then figure out how to allocate the rest. And so while budgets are holding, I will say what we're seeing is couples are being very thoughtful about what matters to them. And so, you know, people prioritize the venue. The dress is another often big ticket, though we are seeing trends in areas like people opting for a vintage dress, perhaps. But we see the dress. Then, you know, you've got catering, you've got a DJ, you've got a photographer, videographer. We're even seeing new categories like content creators enter. And so those are some of the primary categories, florals. But it really is down to what the couple wants. And so what we see is that consumers, especially Gen Z, they want an experience that is authentic to them, that really reflects their personality and their relationship, and so it does vary.
Does that mean they're like seeking out like different types of venues rather than just the typical, you know, banquet hall or church or whatever where we, you know, old folks like me got married?
Well, on our platform, we have a wide range. You know, the barn in upstate New York, Hudson Valley. We've got 2, you know, 5-star hotels, and so there's really a wide range. Again, it really varies on the couple. I would say there's no dominant trend. But that is really the anchor, and then they plan from there. And on average, they're hiring 13 vendors. So, you know, when you think about the complexity, when you think about all the decisions that go into planning the big day and all the dollars, really the vast majority of that is hiring 13 vendors on average.
That's a little over the top, right?
It's wild. My mom did everything, so
we do see that parents, they split the bill. So on average, parents contribute about 50%. So we'll see how that trends, but they do play a role in both the budget and the decision making.
And speaking over the top, you know, I went to a Nigerian wedding about 2 weeks ago.
Did you?
I think it's still going on, by the way. In all seriousness, I am curious, though, about the demographic differences, because there's been a lot of talk about how younger people aren't marrying at the same rate as the older, you know, as the millennials and, or I should say, the boomers did here. Is that affecting the wedding industry at all, that we're not coupling up certainly as frequently? And not only that, but it seems like people are getting married at an older age on average than in the past.
So on average, we see that people get married around 32 or 33. So when you think about Gen Z and the trends, they top out at around 29 right now. So they're almost there. But we're seeing that they are interested in getting married. So despite some of those myths, they are interested in getting married. In fact, 7 out of 10 Gen Z start planning before they're even engaged. They've got their Pinterest board or their inspiration board going. They sometimes even book their venue because, you know, they've grown up on social media and there's so much inspiration out there, so they know what they want. And so actually, you know, despite some of those headlines, we're seeing that they are interested. They're just not quite in that prime range yet.
All right.
Yeah.
All right. Well, this is an interesting conversation. We have to have you back here because we talk a lot about really the importance of you know, the economic conditions and how this is obviously one big feeder into that as well. Great to catch up with you.
Thank you so much. It's just really about the importance of connection and celebration, and so it does stand out from the broader landscape. Thank you.
All right. Raina Moskowitz there. She is the CEO of the Knot Worldwide. Katie, I'm sure you've noticed there are a lot of people at Bloomberg World Headquarters seem to be getting married like in the next 2 days.
A few who are listening very intently right now, I would imagine.
Absolutely. So we have to find out if they were on the Knot or something else here. All right, we're going to set you up here for what to watch over the next 24 hours. Of course, there is a big refocus on what is going on in the global economy, and we do get some economic data starting overnight out of Europe.
Yeah, France and Spain reporting CPI. We also get Eurozone industrial production as well. And then fast forward to the U.S., 8:30 a.m., some interesting U.S. data as well.
We get that PCE number. Now, keep in mind, it's very backwards looking. It's the January numbers because of the delay from the shutdown. But we're also going to get a read on durable goods and an update on GDP UMISH sentiment as well at around 10 a.m. Katie Barfield.
Looking forward to that. It'll be interesting to see what impact, if at all, it has in this market.
Absolutely. A down day here on this Thursday. Tune in tomorrow to find out how Friday ends. Balance of Power is up next on Bloomberg.